This course is about IFRS 9, which is financial instruments. This is a part of a set called IFRS for Beginners. IFRS 9 was issued in 2009 and amended many times. This standard is effective since the beginning of 2018. IFRS 9 superseded IAS 39, Financial Instruments Recognition and Measurements. There are two other standards, which are IAS 32 Financial Instruments Presentation, and IFRS 7, Financial Instruments Disclosures. These standards complement IFRS 9. Actually, all these three standards complement each other. First of all, I think it's better to define financial instrument. A financial instrument is any contract that gives rise to a financial asset of one entity, and a financial liability or equity instrument of another entity. So, in IFRS 9 a contract is very important when recognizing a financial asset or a financial liability. Okay, now it's the time for defining financial asset and financial liability. These are the screenshots from my other course IAS 32 Financial Instruments Presentation. A financial asset is any asset that is cash or an equity instrument of another entity, which means a residual interest in the assets of another entity after deducting all its liability. A contractual right to receive a financial asset from another entity, or to exchange financial assets or financial liabilities with another entity. A contract that will or may be settled in the entity's own equity instruments that are potentially favorable to the entity. This definition comprises financial derivatives with a positive fair value. A financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity, under conditions that are potentially unfavorable to the entity. This is opposite of what I said about financial assets. There is a negative fair value here. A contract that will or may be settled in the entity's own equity instruments. This might be either a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset. The objective of this standard is to establish principles for the financial reporting of financial assets and financial liabilities that will present relevant and useful information to users of financial statements, for their assessment of the amounts, timing and uncertainty of an entity's future cash flows. Let's have a look at the scope of IFRS 9. This standard shall be applied by all entities to all types of financial instruments, except which are within the scope of below standards. IFRS 10 Consolidated Financial Statements, IAS 27 Separate Financial Statements, IAS 28 Investments in Associates and Joint Ventures, IFRS 16 Leases, IAS 19 Employee Benefits, IAS 32 Financial Instruments Presentation, IFRS 17 Insurance Contract, IFRS 3 Business Combinations, IFRS 2 Share-Based Payment, IAS 37 Provisions, Contingent Liabilities and Contingent Assets, IFRS 15 Revenue from Contracts with Customers. All other financial instruments are within the scope of IFRS 9. This standard prescribes four main parts for both financial assets and financial liabilities. These parts are recognition and derecognition, classification and reclassification, measurement of financial assets and liabilities, and the last section is the hedge accounting. Let's go through the details.